What is going on, everyone? Platinum Bees coming at you with yet another video. Today we are going to be looking at a fairly recent article titled Basel III, a gift for physical investors of gold. This article is on Seeking Alpha's website. I will be linking the article in the description down below in case you feel like you want to check it out on your own time. But without further ado, let's get into it. Okay, guys, so we're going to go ahead and dive right on into this article. I thought this would be pretty interesting to go over and talk about on my channel because there's been a lot of talk I've been seeing about this Basel III thing, and I didn't know very much about it until I started to research it a little bit. And it's some pretty interesting stuff. So at the end of the video, I hope to receive you all's comments and thoughts and opinions regarding this, but without further ado, let's get into this. So in the summary, it says here, Basel III agreement will come into force on June 28, 2021 for European banks and on January 1st, 2022 for British banks. It includes the net stable funding ratio requirement. It will make holding unallocated gold problematic. But the NSFR requirement is bullish for allocated gold. According to the Basel III framework, gold will become a zero-risk asset. Overall, Basel III will be great for physical gold. So, let's dive right in and see what it has to say. Basel III is a set of international regulations concerning bank capital adequacy, stress testing, and overall market liquidity. Many of these regulations have been introduced straight after the 2008 to 2009 financial crisis. But there are several aspects of these agreements that will only come into effect on June 28, 2021 for European banks and on January 1st, 2022 for the UK. To sum up, gold will become a risk-free Tier 1 asset and it will become more expensive to buy and sell unallocated gold. These factors are highly bullish for physical gold, so investors of this precious metal will be generously rewarded, provided they buy physical gold, but let me explain this in a little bit more detail. So let's get down here and see. Okay, so it says here, gold as a risk-free asset. Under Basel III, gold will become a Tier 1 asset or a zero-risk asset for most banks. As mentioned in the Basel III framework, at national discretion, gold bullion held in own vaults or an allocated basis to the extent backed by the bullion liabilities can be treated as cash and therefore risk weighted at 0%. In addition, cash items in the process of collection can be risk weighted at 20%. So, interesting stuff. But the interesting point is that gold must be physical and held in the institution's own vaults. It should not be in paper form or owned and leased by someone else. Most gold investments are leased or borrowed or held in paper form. So it looks like major changes are about to come. So we could potentially see what we've all been wanting to see, which is a move away from the paper markets, at least in the metal of gold. I do not know if silver and platinum will take the same route. They could, but we will just have to wait and see. But gold is looking very good, and this is interesting stuff for sure. It doesn't look like they will completely get rid of the paper gold in a sense, but it looks like they're trying to separate the two or treat paper gold as if it's not even gold at all. I'm not really sure. It's really interesting stuff. Since gold will have such a risk-free status, many banks will be encouraged to buy more for bookkeeping purposes. This will also highly encourage every central bank to raise its physical reserves of this shiny yellow metal. So banks are going to start hoarding this stuff legitimately. They're not going to invest so much in the paper market as they are in the actual physical market if this does occur and go through. Now this, I mentioned up here, it talks about it being a European thing. I don't exactly know how that works as far as America and other countries of the world. But we're going to get down into some more of this information. What is more, under Basel III, gold is not even treated as a commodity, but rather as a currency. This basically means the yellow shiny metal is far less of a risk and less volatile than most commodities since, according to the Basel III, currencies tend to be more stable. So this will make it a risk-free asset and will move from being treated as a commodity and treated more as a currency, which us stackers have always wanted to see, perhaps. However, we know that for a very long time now, gold has been more so of a store of wealth and value. It can be used as currency to an extent. However, for the most part, if you want to use it, you're going to have to exchange it for currency, which makes it be more of a commodity at the current time. But we could see that change. As mentioned in the framework, the section sets out the standardized approach for measuring the risk of holding or taking positions in commodities, including precious metals, but excluding gold, which is treated as a foreign currency according to the methodology set out in March 2052 to MAR 2061 above. Okay. And so down here it says Basel III, the net stable funding ratio. Briefly, the NSFR requirement will make the handling of unallocated gold more complicated, but there is a solution to it. In plain terms, the net stable funding ratio will be used to oblige banks to finance long-term assets with long-term money, i.e. greater than 1 year. To avoid liquidity failures, specifically for all precious metals, the NSFR requirement will imply an 85% required stable funding RSF to be held by banks against the financing and clearing of precious metals transactions. This is a highly significant rise compared to its pre-Basel III level of 0%. As mentioned in the framework, assets assigned at 85% RSF factor comprise physical traded commodities, including gold. In plain terms, it suggests that regulators are now considering gold to be an illiquid asset that is even riskier to hold than exchange-traded equities, which have an RSS of 50%, and as risky as all other equities. All that sounds quite unpleasant for the banks and their bullion business, but does it mean there will be no way to hold physical gold bars or any other form of gold without fulfilling this requirement? No, I would just say the opposite is true. Specifically, clearing members could solve this RSF problem by allocating their precious metals. What exactly does it mean? Allocating simply means converting the client's accounts from unallocated to allocated gold. Let me explain this with a simple example. Let us assume that a clearing bank has 40 customers holding the pool of the 50 billion unallocated gold. The bank can allocate gold bars from its balance sheet to each of its 40 clients. By converting the client's accounts from unallocated to allocated, the clearing bank can avoid the negative impact from NSFR on its gold business, as it will end up no longer holding gold on its balance sheet. This will be great for the clearing banks. However, the requirement to hold gold on an allocated basis will still be more expensive than holding it on an unallocated basis, so the cost will still rise. And this makes sense because holding nothing costs nothing, but holding something, there's going to be a cost added to it, right? So that makes sense. But what is the exact difference between allocated and unallocated precious metals? This is quite a big difference. In my other article, I wrote about SPDR gold shares, exchange traded fund, GLD, and the difference between paper gold and physical gold. In short, allocated gold is physical gold, whereas unallocated gold is paper gold. So it's held in, and nowadays they don't really trade actual physical paper. It's all digital. So yeah, we stackers know what the difference for the most part between paper and physical is. Allocated gold suggests you are the direct owner of the yellow metal and you have no counterparty risk. Unallocated gold, however, remains the property of the bank. The investor is a creditor of the bank, but it's not the direct owner of the bullions. So, down here it says, as my colleague Sprott Money explained in his excellent analysis, unallocated gold can be borrowed, loaned out more than once. So, yeah, that's just sketchy from the get-go. This means there might be many claims on the very same amount of gold. That cannot happen with allocated gold by definition. In other words, the banks will be punished for holding unallocated gold and rewarded for holding the actual unleveraged physical metal. In simple words, this makes it expensive for banks to engage in any form of hypothecation or gold lending. This is also important because gold lending is one of the main tools used to short gold. That is why reducing this activity makes it more complicated to short the shiny metal and is therefore bullish. So interesting stuff. Interesting stuff for sure. It's looking like there's much more push to remove gold from the paper market or discourage paper trading of gold and separate the two completely into two completely different categories at the very least. Down here in the conclusion, it says the Basel III agreement will have a major impact on the European banks and also on the UK banks. The net stable funding ratio requirement will make it difficult for banks and other institutions to keep unallocated gold. So one of the likely solutions will be to allocate gold. The very fact that gold will become a risk-free asset is highly bullish. It will make central banks and other investors raise their gold reserves. All this is highly advantageous for investors holding physical gold. So, and down here in the disclosure, it gives a little bit of information letting the readers know that this person is somewhat unbiased in what they are writing about. But this is very interesting stuff. I hadn't really heard about Basel III until some of my commenters were mentioning it and some people were talking about it, but it's interesting stuff for sure. If this were to all go through as they say it is, especially in Europe in June 28, 2021 and January 1st, 2022, we could see it have a major impact on gold and gold become a very bullish asset. Now, I'm bullish on gold anyways from the get-go, but this only makes me more bullish and probably will bring a lot more investment demand to the table, knowing that banks will not be allowed to, deal with paper gold as much or in the same manner that they were beforehand. But overall, guys, this is very interesting stuff, and I highly suggest you go check out this article as well as Seeking Alpha. They have some great info on their website. Like I mentioned in the beginning of this video, I will be linking this article in the description down below for you all to look at your own leisure. I appreciate everyone stopping by and checking out the video. Be sure to hit that like button on your way out. Be sure to hit that subscribe button if you have not already, and leave me a comment in the comment section down below letting me know what your thoughts are on Basel III. So with all that being said, guys, until next time, we will see.